The 2023 car market collapse is defying earlier expectations. While the used car market plummets, automakers grapple with production disruptions, tightening inventory, and mounting price pressures as the year nears its end. Major Wall Street banks, JP Morgan and Morgan Stanley among them, caution that this crisis threatens to destabilize the economy and royal financial markets this autumn. Today, we'll explore its potential impact on American consumers in the coming months. Stay tuned till the video's end. September hasn't been smooth sailing for car dealers and manufacturers. Despite months of production improvements, manufacturers have had to slow down as new car sales stagnate. Additionally, supply chain issues are plaguing some car companies, negatively impacting their financial performance. The month kicked off with Hyundai Motor North America's CEO, Jose Maner, expressing concern over slowing growth and the brand's precarious position. Donworth, also Hyundai Motor Company's global COO, stressed, "We are in crisis mode." About a week ago, August data revealed a deepening industry downturn. While new auto prices saw a slight 0.3% increase compared to nearly 4 percentage points last year, it suggests new car prices might have hit a temporary plateau. Conversely, the used car market witnessed the most substantial August price drop in over a decade, with prices down by 6.6%. However, Cox's Automotive warns that used car prices may not have bottomed out. Since January, some popular models have suffered a steep 30% decline as used car supply steadies and demand dwindles. Furthermore, vehicles are taking longer to sell. A study analyzing 228,000 car transactions of 1 to 5-year-old used vehicles by online marketplace ICAR.com reveals new models take 29% more time to leave lots, while popular used cars need 26% more time to sell in Q3. The study reported that the used Tesla Model S, for instance, now takes an average of 88 days to sell, with prices dropping from $69,877 in January to $65,625 last month. Similarly, Ford's Mustang Marquee, selling at $44,250 down from $46,955 at the beginning of the year, takes 76 days to find buyers. Similarly, Ford's Mustang Marquee, selling at $44,250 down from $46,955 at the beginning of the year, takes 76 days to find buyers. ECONOMIST.com also noted that the Land Rover Discovery Sport requires 74 days to sell at a fair price of $32,066, compared to months ago at $36,899. Cadillac's XT4, now selling for $31,600, took 72 days, down from $33,400 in the first quarter. Tesla's Model X lingers for 71 days at dealerships, selling at $77,835, down from $77,900 in January. A Range Rover sits on the market for 68 days, with prices slipping from $79,333 at the start of 2023 to $75,600. Meanwhile, Chevrolet Blazer takes 65.9 days and costs $31,644, down from $38,750. The Chrysler 300 sells after an average of 64.7 days on the market, with prices at $25,200. Similarly, the Buick Enclave transitioned from $39,175, and dealers require 64.3 days to sell the model. These price fluctuations significantly impact car buyers, especially with rising interest rates increasing auto loan payments. On the flip side, car dealers are feeling the pinch as demand cools down. Initially, used car prices surged due to a lack of new car inventory, as explained by iCar.com's executive analyst Carl Brauer. However, there are now abundant new cars on dealer lots, but consumers aren't rushing to buy them. Regarding the new car market, the landscape is drastically different. According to Reuters analysts, with the United Auto Workers Union initiating a strike, the new car segment is poised for turmoil once again. The UAW strike against Detroit's three automakers, General Motors, Ford, and Stellantis, commenced around a week ago. This marks the first-ever simultaneous strike across three automakers, with more than 12,000 workers demanding improved pay and benefits. They are currently centered at one U.S. assembly plant for each company. Insiders believe that if no agreement is reached by the end of this week, the strike could quickly escalate in terms of participants and locations. Together, General Motors, Ford, and Stellantis account for about 43% of new cars sold in the U.S. In other words, the disruption in the supply chain could reach staggering proportions. If the auto worker strike persists for a couple of weeks, it could strain the supply of popular vehicles and trigger a surge in car and truck prices. If the auto worker strike persists for a couple of weeks, it could strain the supply of popular vehicles and trigger a surge in car and truck prices. J.P. Morgan's chief U.S. economist, Michael Fink, is cautious. He has warned that a prolonged nationwide strike could disrupt production and lead to inventory shortages this year, posing a substantial upside risk to new car prices. Rob Hanfield, a Bank of America University professor specializing in supply chain management at North Carolina State University, adds that a month-long strike could result in significant supply and demand imbalances, removing several models from the market. He estimates that a strike of that duration could lead to roughly a 10% price increase for affected vehicles. If it extends for 2 months, dealerships might run out of cars completely. While it's too early to determine the strike's duration and its impact on auto plants, consumers are already anxious about how these work stoppages will affect their ability to purchase new or used vehicles or to repair their existing ones. Tom Maioli, an owner of a Ford dealership in New Jersey, notes that consumers are growing jittery, unsure of what to do. It's a nervous time for them, and they may not realize that the most significant issue could be the availability of parts, such as tires and brakes, needed to keep their cars running. The labor unrest could also have significant repercussions for the U.S. economy. J.P. Morgan analysts warn that the substantial wage increase sought by the UAW, a 40% rise over 4 years, could trigger inflation across various industries, ultimately affecting consumers. American businesses and policymakers appear poised to confront another inflationary challenge. Using the 2019 auto workers' strikes as a reference point, Morgan Stanley's Ellen Zettler estimates that higher prices for new vehicles could add 2 percentage points to the monthly Consumer Price Index, CPI, given that the transportation sector constitutes about 16% of the CPI. The potential combination of soaring new car prices amidst dwindling inventories and a substantial wage settlement could swiftly reverse recent declines in inflation figures. To complicate matters further, Morgan Stanley economists suggest that this could negatively impact U.S. economic output and payrolls, potentially contracting GDP by nearly a full percentage point in the fourth quarter. To complicate matters further, Morgan Stanley economists suggest that this could negatively impact U.S. economic output and payrolls, potentially contracting GDP by nearly a full percentage point in the fourth quarter. Amid rising oil prices, with a potential return to $100 per barrel, the situation becomes even more precarious. Crude futures have increased by 30%, marking oil as an inflationary factor rather than a deflationary one. Over the past 30 days, gasoline prices have surged across the United States, reaching a peak of $3.98 per gallon in the third week of August, as reported by the U.S. Energy Information Administration. This is a worst-case scenario for Federal Reserve policymakers and financial markets, as they grapple with the implications of supply chain disruptions, semiconductor shortages, and part shortages in driving inflation to its highest level in over 4 decades. To achieve their 2% inflation target, they will likely need to prolong interest rate hikes. However, the precarious state of financial markets presents a risk, particularly due to their exposure to auto loans. As interest rates rise, the number of delinquent and defaulting auto loans is expected to increase. For years, Wall Street profited from subprime auto loans, and investors have flocked to bonds backed by auto loans in search of attractive returns, even during economic downturns. Consequently, since 2020, the nation's auto loan balance has surged by 28%, surpassing $1.5 trillion. This makes it the fastest-growing category of consumer debt in the U.S., according to the Federal Reserve Bank of St. Louis. Auto bonds have also surged since 2018 as lenders bundled these loans into securities, often deemed safe investments by rating agencies. In 2021 and 2022, lenders sold bonds containing $76 billion in subprime loans. However, this growth was based on the assumption that the majority of borrowers would consistently make their monthly payments. Joseph Kaji, a finance and corporate insolvency specialist at Davis & Gilbert in New York, notes that investors and lenders appeared confident about the situation. However, for the first time in nearly 2 decades, this winning streak is in jeopardy, with several major used auto lenders facing a potential wave of loan defaults and heightened regulatory scrutiny. However, for the first time in nearly 2 decades, this winning streak is in jeopardy, with several major used auto lenders facing a potential wave of loan defaults and heightened regulatory scrutiny. The Consumer Financial Protection Bureau has initiated lawsuits against numerous lenders over potentially predatory practices. Signs of trouble emerged in late February when American Car Center, specializing in loans for customers with challenging credit histories, abruptly closed its 40 southern dealerships and filed for bankruptcy protection. A few months later, U.S. auto sales also collapsed, leading to the closure of multiple dealerships in various states. Presently, delinquency and default rates on auto loans are skyrocketing. Rating agencies report that the number of subprime borrowers behind on their auto loan payments by 60 days or more is the highest since at least 2017. With the conclusion of pandemic aid programs and the Federal Reserve raising interest rates 11 times since March 2022, an increasing number of Americans are struggling to meet their expensive loan obligations. The prospect of widespread defaults is no longer distant, potentially sparking a sudden upheaval in the U.S. financial system. Earlier this year, when Elon Musk cautioned his Twitter followers about the auto loan crisis leading to the worst financial crisis ever, media outlets promptly dismissed his asserting that the two sectors were not directly linked. However, the connection is now apparent. A historic car market crash is already unfolding, evident to anyone who cares to observe. Thank you for your attention.